Hey everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster with Victory Fiduciary Consulting, and it's good to be back. Took a break last week. I actually went away with my family, and so we were in Maryland for the week, had a lot of fun, stayed socially distant, wore masks, washed our hands all the time, but it was good. It felt like a little bit of normalcy. But we're back. There's so much to talk about, so we're just going to go ahead and get right into it today. I feel like every time I come in to do my video, I'm talking about the fact that, something else crazy or has happened that was unexpected. And so right now, markets continue to react very irrationally. Volatility continues to remain. Last week, we saw the Dow actually do a 1,000-point reversion in one day. It was actually up 500 points, closed 500 points lower, and that was right after California announced that they were going to have to roll back reopening and possibly have to go into lockdowns. And so obviously the market took that as a very negative impact upon recovery. And so we continue to see these days in the market where not signs of a healthy market at all, certainly signs of a market that continues to remain under pressure and just a market where volatility and emotion is kind of ruling the roost at this point. And so this week especially, it's been really interesting. So as you know, we're waiting for Congress to come back and let us know, number one, if we're going to have any additional stimulus and any additional checks to families to kind of help support through this economic downturn that we're going through. The big story, though, is are we going to get the $600 a week extended for those who are on unemployment benefits? And so this can have actually a pretty significant impact on the economy, especially consumption in the economy, because we know that there was a fair amount of people that were actually making more while on unemployment than when they were employed. And so most likely there was a lot of additional money that was being spent in the economy. And so it's going to be interesting to see if Congress, because we're going to be able to get it together and come out with a new program that will be able to support. Now, if they do, that has a whole other list of implications that we won't get into here, just to say that the market is absolutely watching, waiting to see what's going to happen. I mean, we are basically on the edge of a financial cliff at this point, that if something is not passed soon, there is going to be some significant issues in the very short term. But obviously, right now, I think the market is kind of assuming that we're going to go ahead and pass something. It's going to mean that Democrats, Republicans are going to have to work together to get something done. We know that states are continuing to either pause their reopening or actually backtrack. And so we've seen that over the past few weeks. We've already kind of talked about that at length, but that continues to happen. And so this chart, I really just want to begin to kind of try to show you in graph form, though, where we have actually gone within the S&P 500. And so if you remember, back at the very beginning of March, there was a lot of exuberance in the market. That was right when we had some exciting news about possible vaccine trials that were having some positive results. And then really the market has gone nowhere since the beginning of June. So just Monday was the first time up here. You can see that we were just able to finally begin to break out of that consolidation. So it'll be interesting to see where we go from here. S&P 500 performance has been largely influenced, so remember, by just 5 individual companies right now. 1 out of 5 companies in the S&P 500 has actually been positive for the year. The rest have been negative. And so we know that we are right smack dab in the middle of earnings season. And so this is one of the things that we've been waiting to kind of see how earnings seasons is going to potentially impact kind of the decisions that investors are making. And so we have about another 2 weeks left in that. Just on Friday, Netflix came out and really disappointed investors when they gave their forward-looking projections in terms of new users that they would be expecting to be bringing on. And I think that kind of shook the market a little bit, like, how can Netflix not be as strong as we thought, considering within the pandemic people are staying home? And so I think, again, earnings seasons can really make or break a lot of these, companies and price and just what people are willing to pay for their companies. So this is going to be on my tombstone, I think, eventually, when I say that eventually earnings are going to matter. And so I know right now it might not seem like it. The market remains completely detached from earnings. completely detached by what's going on with the economy, completely detached with what our GDP currently is and what the estimates are for moving forward. And so I really just wanted to show you that, see, when we look back in history, though, earnings always have mattered. GDP has always mattered. Economic activity has always mattered. It eventually will. We can run detached for a period of time, but I want to show you. So when we look back here, what happened with 2000 and with what was happening with the actual earnings of the S&P 500, and then look at 2008, what happened here. So we can see absolutely the S&P 500 eventually was affected by the fact that earnings were disappointed, that GDP was disappointing. And so here, this line right here is just showing that was what the average GDP growth was expected versus what actually happened. And so you can see where we are over here. Here we are growing up here. Here we are with expectations for GDP for this year. And so just going to show, eventually it is going to matter. Something we haven't spent a lot of time on, and I think that it makes sense to talk about the fact that, we've never seen the Nasdaq run so completely detached from the S&P 500 ever in history. And so typically the S&P and the Nasdaq, they run fairly close together when we look at performance. So actually, interestingly enough, the last time the Nasdaq was this detached from the S&P was in March of 2020. And so we know that obviously there was a huge outside force that caused that significant correction. They came back down. And so here we are with the Nasdaq. Here's the S&P. And again, S&P and Nasdaq are so super concentrated right now in, we call them the FANG stocks. So Facebook, Amazon, Apple, Netflix, Google, Microsoft. Those are the areas that we see such concentration with. You take those companies off the table and performance is hardly anything. And so, what we're seeing is that greed remains at all-time levels right now in the market, but eventually the Nasdaq and the S&P are going to have to be running concurrently again, and history has shown us that it's always the Nasdaq that comes down and meets the S&P, and then typically when that outside pressure comes, the S&P falls quite a bit lower also. And so what that outside pressure is going to be, I don't know. Is it going to be that the economy shuts down again? Is it going to be rising tensions with us and China? We just shut their consulate down in Houston. I don't know what that pressure is going to be. I just know that at some point it's not going to take much. And when the Nasdaq does fall, it will likely fall hard, sharply, and unexpectedly. And just one last point with these charts that I want to show. This is just showing the Nasdaq again with their 50-day and 200-day moving averages. So when we look at averages, we have to at some point be trending near them. That's how averages work, right? So here we are with the 50 and the 200 moving the average for the Nasdaq, and look how much extended we are trading above that. That cannot happen for very long before a reversion will happen. And so, really, it's almost like the market's got these sirens calling investors like, come and invest. You're not going to lose any money. Companies can only make more. Earnings don't matter. All of these things. And it's kind of like, as advisors, we're kind of stepping back wondering like, but all we can do is look at what we know. We can look at the numbers, at the charts, at the rules. We take the information that we have. And it's tough as an advisor when we're in these areas of unprecedented events like we are today, because as a fiduciary, I have a responsibility to make sure I'm investing my clients' money in a way that's prudent. And as much as I want to be able to participate in all the performance that I can, I also want to make sure that I can mitigate risk within my clients' portfolios. And, right now, knowing what we know and that the chance of there being a sharp downside correction in the near future really makes it, tough for us to be able to be really aggressive at this point. What we do know is that risk is significantly elevated. And we look back at that chart at the S&P 500 and we think that the reward probably isn't super high right now where the markets could go. Could they absolutely go a little higher? Yeah, they can in the short run. But over the long run, we really believe that there's going to be a much better buying opportunity in the near future. And so that's kind of where we are. Talking about, wanting to mitigate risk. We want to try to protect downflows. We also want to try to find ways for participation. We did just today increase our individual retail client portfolios up to 50% fixed income. Right now, when we look at our dynamic asset level investing chart, fixed income is actually in number 1 right now, so those would be bonds. Cash is number 2, domestic equities is 3, so we are up to 50% holding fixed incomes. Our 401k clients are still in a stable value fund because that gives a guaranteed yield with virtually no risk, so we stayed there. We are looking at adding a few very minority equity positions in the short term. Those are areas that are very, very targeted in areas that we think could do well even in the midst of a market pullback. Again, very, very minority positions, but allowing us to participate a little bit. I can tell you we will not be buying the S&P 500 index. We will not be buying the Dow Jones Industrial Average Index right now because, again, they're overextended, they're overpriced, they're running detached, but we have found some areas that we think will do well. And so really as investors, I think that the big takeaway here is that it's really time to pay attention. Pay attention that if you're managing your own portfolios, how much risk is on the table. If you are invested heavily in equities, thinking is it time to maybe take some off the table right now. We're doing that so that we know we can deploy additional assets into other areas of the market as these corrections come. And so, that is what I wanted to get into today. And so I really do thank you for tuning in. I'm really enjoying doing these videos. I really encourage you that if you have comments, questions, have ideas that you'd like me to talk about next week, you can always email me or you can give me a call. I thank you again and hope you have a great week. Stay well.